Welcome back to the Deep Dive. This time we're diving into the world of finance, specifically with Financial Knowledge You May Not Know by Flowers on a Jaguar's Head. We've got excerpts on IPOs, hedge funds, even corporate governments. Looks like we've got a lot to cover.
Yeah, a lot to unpack. And what really stands out is the author's attention to detail. It's like they really want to show you how these complex financial mechanisms work, not just give a surface-level explanation.
So before reading this, I always thought companies went public mainly to raise capital, but this first excerpt really challenges that assumption.
Right, it's a common misconception. While needing money is definitely a factor, the book highlights another motivation. Pressure from early investors. Imagine investing in Facebook back in 2004. By 2011, you'd be looking at a 10,000x return. An IPO is how those early investors finally get their payday. It's their exit strategy.
So it's like a reward for those who believed in the company from the start, but there must be some advantages for the company itself as well. I mean, it can't just be about making the early investors happy.
Exactly. Going public is like leveling up in the financial world. Suddenly, the company has easier access to loans, more credibility with investors, and it opens up a whole new avenue for raising capital through the stock market.
So it's almost like getting a VIP pass to the capital markets.
Exactly.
And we can't forget the free publicity. Going public generates headlines, puts the company in the spotlight. Could even attract more investors.
True, but that increased visibility comes with a price greater scrutiny. Everything the company does becomes much more transparent: financial reports, business practices, even the decisions executives make. And they're constantly under the watchful eye of analysts and the media.
It's like stepping onto a bigger stage with brighter lights. Now, this is something I've always wondered about. The book mentions how often a company's stock performance dips after an IPO. If going public is such a positive step, shouldn't the stock go up?
You'd think so, right? But it's a great question and gets to the heart of how IPOs are often structured. One theory is that companies time their IPOs to coincide with a peak in their valuation, like trying to catch a wave just before it crests.
So it's like they're trying to sell high before the market catches up to reality.
In a way, yes. Eventually, the market adjusts and the initial hype dies down. The book also mentions something called earnings management, where companies might present their financials in a more favorable light before going public.
So they might be putting on a bit of a show to attract investors. Makes you wonder if those pre-IPO numbers always tell the whole story. This reminds me of another topic the book covers: mergers and acquisitions, or M&A. Things can get pretty cutthroat.
Oh, absolutely. The author uses some really colorful language to describe different M&A tactics, like the bear hug, where a company bypasses management and goes straight to the target's board with their offer.
That sounds intense, almost like forcing their way in. And then there's the poison pill. Now that sounds like something straight out of a spy movie.
It's a pretty dramatic name for a defensive strategy. Basically, the target company makes itself less attractive to the potential acquirer, maybe by taking on more debt or restructuring in a way that makes the acquisition more costly and complicated.
It's a pretty smart way to discourage unwanted suitors. Kind of like a pufferfish puffing itself up to look bigger and more intimidating. The book also talks about the Pac-Man defense, which sounds like a complete reversal of fortune.
Right. That's where the target company tries to turn the tables and acquire the company that's trying to acquire them.
That's bold. Does that ever actually work?
It's rare. Usually it's the bigger fish trying to swallow the smaller one.
Speaking of how companies operate, the book also gets into corporate governance. I used to think it was just a bunch of boring rules and regulations. But this author compares running a public company to managing a humble dumpling stand.
It's a great analogy, isn't it? It really highlights how even a seemingly straightforward business is actually more complex than it appears. You have the shareholders who own the company, but they don't actually manage the day-to-day. That's up to the management team led by the CEO.
Right, so there's this situation between ownership and control, which could lead to some conflicts of interest.
Exactly. That's where corporate governance comes in. It's like a set of checks and balances designed to make sure the company is being run in the best interests of the shareholders and not just for the CEO's personal gain.
So it's all about making sure the game is fair for everyone. But what about those massive CEO salaries we hear about all the time? How does that fit into this idea of responsible corporate governance?
That's a great question, and one that often sparks debate. The book goes into detail on this topic. It turns out a large part of CEO compensation often comes in the form of stock options. The idea is to tie the CEO's financial success to the success of the company, so they're incentivized to make decisions that will increase shareholder value.
So if the company does well, the CEO does well, and vice versa. Seems fair in theory, But doesn't that create some potentially dangerous incentives?
You're right to be cautious. The book does acknowledge that stock options can lead to CEOs focusing on short-term gains, even at the expense of the company's long-term health. They might be tempted to take bigger risks or even manipulate earnings to bump up the stock price, even if it hurts the company in the long run.
It's like a gambler going all in on a risky hand. They might win big in the short term, but risk losing everything. So it's about finding that balance, motivating CEOs without encouraging reckless behavior. Now let's move from CEOs to hedge funds. I always thought hedge funds were only for the ultra-wealthy, something you'd see in a movie about Wall Street.
There's definitely a bit of mystique around hedge funds, but they aren't entirely out of reach, though they do usually cater to investors who meet certain income and net worth requirements. What's interesting is that the book highlights how hedge funds are all about making money regardless of what the market's doing. They use sophisticated strategies and aren't afraid to take on higher risk for those returns.
So they're kind of like financial daredevils, exploring uncharted territories and taking risks most investors wouldn't even consider. So what kind of strategies are we talking about?
One key tool is leverage. Remember our discussion about using borrowed money to amplify bets? Hedge funds use this a lot. This can lead to huge gains, but also massive losses.
High risk, high reward. The book mentions different types of hedge fund strategies, right?
Exactly. You've got the global macro approach where they bet on things like currency movements or interest rate changes on a global scale. Then there's event-driven where they capitalize on mergers, acquisitions, even bankruptcies. And then there's market neutral where they aim to minimize risk through a combination of long and short positions.
So they're constantly trying to predict market moves and making calculated risks to stay ahead of the game. Speaking of risk, the book also talks about interest rates and how they can be a double-edged sword.
The author compares lower interest rates to a stimulant. They might provide a temporary boost to the economy, but are there any long-term consequences?
Like a sugar rush, you get a burst of energy, but then,
You crash later on. The book uses recent rate cuts in China as an example.
oh, right. Lowering interest rates can encourage borrowing and investment, which can stimulate economic activity. But if that money doesn't go into productive investments, what happens?
You got it. It can lead to inflation, which ultimately reduces people's purchasing power.
So central banks have to find that sweet spot. Encourage growth without causing too much inflation. It's like walking a tightrope. All of this really emphasizes just how interconnected everything is in the world of finance.
Absolutely. One decision can have ripple effects throughout the entire system, and understanding the details of those ripple effects is crucial for navigating this complex world effectively. It really is, and the book goes even deeper into what happens after a company goes public. It's not always smooth sailing, and IPOs often come with this strange phenomenon, a dip in stock performance right after the IPO.
Yeah, I was just thinking about that. If going public is supposed to be such a positive thing, why would the stock go down? Seems kind of counterintuitive.
Right, you'd think it'd be all celebrations and good news, but remember what we were talking about with early investors? One theory is that companies strategically time their IPOs. They wait for that moment when their valuation is at its absolute peak, kind of like catching a wave right before it quests.
So they're trying to take advantage of all the excitement and hype around the IPO, get the best price possible.
Exactly, but the market eventually catches up and that initial buzz fades away. The book also talks about earnings management, which is where some companies might, well, let's just say they present their financials in the most flattering way before going public.
Ah, so they might be putting on a bit of a show to attract investors. Makes you wonder if those impressive pre-IPO numbers are always telling the whole story. All this strategic maneuvering reminds me of another topic the book covers, mergers and acquisitions, or M&A. It can get pretty aggressive.
Oh yeah, the author uses some really colorful language to describe the different types of M&A tactics. We already talked about the bear hug, where they go straight to the board. But there's some other really interesting tactics too.
The poison pill definitely got my attention. It sounds kind of sinister.
Well, it is a defensive strategy. And a pretty effective one. It's where the target company basically makes itself less attractive to a potential acquirer. Maybe they take on more debt, change their structure, or even enact some shareholder rights plans that would make the acquisition more expensive or difficult to pull off.
So they're basically making themselves look less appetizing to an unwanted suitor. Kind of like a pufferfish.
Exactly.
And then there's the Pac-Man defense, which is basically the opposite.
Yes, the Pac-Man defense. That's where the target company tries to flip the script and acquire the company that's trying to acquire them. It definitely highlights the power dynamics in the M&A world.
It's like a David and Goliath story, but in the corporate world. I wonder if it ever actually works.
It's rare. Usually the company that's initiating the acquisition has more resources and more power, but it shows you that even in a field like finance, which can seem pretty ruthless, there's still room for surprises and clever strategies.
Speaking of strategies and how companies operate, the book also digs into corporate governance. I used to think it was all just a bunch of boring rules, but the author makes it pretty interesting. I love the analogy they use comparing running a public company to running a dumpling stand.
It's a brilliant analogy, isn't it? It shows how Even a seemingly simple business can have all these complicated relationships and responsibilities. In a public company, you have shareholders who own the company, but they don't necessarily run things day to day.
Right, that's the management team led by the CEO.
Exactly. So you have the separation between who owns the company and who controls it. And that can create some potential conflicts of interest.
So how do you make sure that everyone is working towards the same goals, that the company is being run in a way that benefits both the shareholders and the company itself?
That's where corporate governance comes in. It's like a system of checks and balances to make sure things are fair and that the company is being run in the best interests of the shareholders, not just the CEO or other executives.
So it's all about transparency, accountability, making sure everyone's playing by the rules. What happens when corporate governance breaks down? Are there real-world consequences?
Unfortunately, yes, the book uses the Enron scandal as an example. That was a major corporate collapse, cost investors billions. It shows what can happen when you don't have accountability and transparency.
So it's not just about following the rules for the sake of it. Strong corporate governance protects investors, maintains market integrity, and ensures the long-term health of the whole financial system.
Absolutely. And that brings us from corporations to something a little wilder, hedge funds.
Oh yeah, hedge funds, I'll admit, they've always seemed a bit mysterious and intimidating to me.
They definitely have that reputation, don't they? A bit more daring than traditional investment funds. But the book demystifies them a bit, explains what they do and their role in the financial world.
So they're like the risk takers of the financial world.
That's a great way to put it. One of the key things to understand is that hedge funds are all about absolute returns. They're not like your typical mutual fund that's trying to beat a certain benchmark. They want to make money no matter what the market is doing. And they're willing to take on more risk, use more sophisticated strategies, and go beyond the limits of those traditional investments to get those returns.
So they're like the financial equivalent of those extreme athletes, pushing the limits.
Exactly. And one of their main tools is leverage. Remember, we talked about using borrowed money to amplify your bets? Hedge funds use leverage a lot, which can lead to those huge gains, but also those huge losses.
High risk, high reward. It's like playing financial poker with really high stakes. What kind of strategies do they use? How do they actually place these bets?
Well, the book gets into several hedge fund strategies. Each has its own unique approach and risk. There's the global macro approach where they bet on big economic trends, changes in interest rates, currencies, commodity prices. Think of George Soros and his famous bet against the British pound back in '92.
Wow, that was a legendary move. Betting against an entire country's currency. It must take a lot of guts and understanding of a global economy. What other strategies are there?
Another common approach is event-driven investing. This is where they try to profit from specific events like mergers, acquisitions, spin-offs, or even bankruptcies. They analyze how these events will likely impact stock prices and then position themselves accordingly.
So they're like financial detectives, piecing together clues and figuring out how things will play out. Sounds fascinating, but incredibly complex.
It is. Then there's market-neutral investing, which aims to make money regardless of whether the market goes up or down. They do this by carefully balancing their bets, both for and against certain stocks. It's a way to minimize their risk.
So it's like hedging their bets, creating a portfolio that can handle the ups and downs of the market. Sounds less risky than the other approaches, but I bet it still takes a lot of expertise.
You're absolutely right. And it's important to remember that hedge funds aren't all the same. They can be very different in their strategies, how much risk they take, and how successful they are. Some are really successful, while others, well, they don't do so well. It's a world of extremes, where skill, luck, and timing all play a part.
Now, moving on from hedge funds, let's talk about something that affects all of us, regardless of whether we invest in them or not, interest rates. The book describes them as a double-edged sword. They can help the economy grow, but they can also hold it back.
Right. The author compares lower interest rates to a stimulant. It's like a temporary boost, but then what?
Like a sugar rush, you get all that energy, but then you crash.
Exactly. The book specifically mentions recent rate cuts in China as an example.
Yeah, I remember reading about that. Lowering interest rates makes it cheaper to borrow money, so businesses and people are more likely to spend, and that stimulates economic activity. But like you said, there can be downsides.
Right. If all that borrowed money doesn't actually go into productive investments, then it can actually lead to inflation. Too much money chasing too few goods and services, that pushes prices up.
And that erodes everyone's purchasing power. So it's this tricky balancing act for central banks, right? They need to encourage economic growth without creating too much inflation.
Exactly. It's like trying to keep a kite flying steady in the wind. You don't want it to fly too high or dip too low. The decisions they make about interest rates have a ripple effect on the whole economy. Everything from mortgages and car loans to how much businesses invest.
It's really amazing how one little number can have such a big impact on our lives. It makes me realize just how interconnected everything is in the financial world. one decision can set off a chain reaction influencing all these other things.
That's exactly the point. It really underscores the importance of understanding these complex systems. And this book does such a great job of breaking it all down and showing us the real story behind the headlines.
It's like getting a peek behind the curtain. But with so much to learn, it can feel kind of overwhelming. Where do you even begin to make sense of it all?
That's a great question, and the book addresses that directly. It really emphasizes that knowledge is your most powerful tool in the financial world. The more you understand, the better you can make informed decisions, manage risk, and reach your goals.
So it's not about becoming an expert overnight. It's more about being curious, willing to learn, and maybe having a healthy dose of skepticism.
Absolutely. And that leads us to another fascinating topic. The book dives into stock picking. It's something a lot of people find really interesting, but also pretty intimidating. Where do you start? What are the secrets to success? And most importantly, how do you avoid losing everything?
Those are great questions, and I bet our listeners are dying to know the answers. Let's explore what the book has to say about stock picking. What are the key takeaways? What details really matter? And how can people use this knowledge to make smarter investment choices?
Well, the book takes a really practical approach to stock picking, and it emphasizes starting with the big picture, analyzing the overall economic climate.
Makes sense. Before you even start looking at individual companies, you need to understand what's going on in the world around them. What are some of those key economic indicators to watch?
The book talks about paying attention to government policies, things like changes in taxes or spending, and how those policies might affect different industries. For example, if the government decides to increase infrastructure spending, that could be good news for companies in construction or those that provide materials for those projects.
Right, so it's all about understanding those domino effects, how one decision or event can lead to a whole chain of consequences. So understanding the bigger picture is step one. What's step two?
Step two is all about analyzing different industries, and this is where things get really interesting. The book encourages investors to really tap into their own knowledge and experiences.
So it's not just about looking at financial statements and spreadsheets. You can use real-world observations, too.
Exactly. Think about industries you're familiar with, products you use, trends you notice in your everyday life. The author actually tells a funny story about how his wife inspired him to invest in Hanes, the company that makes Legs pantyhose.
Really? How'd that happen?
He was so impressed by how much she loved the product, the quality, how popular they were. He thought, hey, maybe this is a good company to invest in.
That's a great example of how everyday insights can lead to investment opportunities. Sometimes the best ideas are right in front of us. But how do you go from those observations to actually making investment decisions?
It's about connecting the dots, what you see happening in the world around you and how that might translate into potential investment opportunities. For example, if you notice that more and more people are going vegan, you might start researching companies that make plant-based foods. Or if you see electric vehicles getting really popular, you might look into companies that make those cars or the batteries that power them.
So it's about combining your own knowledge and experience with traditional financial research, getting a more well-rounded perspective, like a detective gathering clues and piecing together a story. But once you've identified some industries that look promising, what's the next step?
That brings us to step three, researching specific companies within those industries. This is where you dive into the nitty-gritty, their financial performance, how good their management team is, what competitive advantages they have, and of course, how much they're valued at. You want to understand what makes a company tick, what its strengths and weaknesses are, how it stacks up against its competitors.
So you really need to go beyond the surface and dig deep, understanding a company's operations, their financials, their long-term prospects.
Exactly. And the book stresses the importance of sticking to your own investment style, your own tolerance for risk. Don't just chase the latest hot stock because everyone else is. Invest in companies that you actually understand and believe in, companies that align with your financial goals and your personal comfort level when it comes to risk.
It's about finding that sweet spot where your interests, your knowledge, and your financial goals all come together, building a portfolio that reflects you and helps you reach your long-term objectives. But with all this talk about potential gains and winning stocks, we can't forget that investing always involves risk.
Right. The book has this powerful analogy. It compares stocks to weapons. They can be used to build wealth, but they can also cause a lot of damage if you're not careful.
That's a good reminder. Investing is serious business. The decisions you make can have a real impact on your financial well-being. So what are some of those key risks people need to be aware of when it comes to stocks?
One of the biggest risks is market volatility. Stock prices can swing up and down dramatically in a short period of time, and that can be influenced by all sorts of things, news events, economic reports, even just how investors are feeling at a particular moment. It's important to be prepared for those ups and downs. Don't panic and sell just because the market has a bad day.
Like riding a roller coaster, there are going to be some thrills and chills along the way, but if you hold on tight and stay focused on the long term, you're more likely to get to where you want to go.
Exactly. Another risk to keep in mind is what's called company-specific risk. Even the most promising companies can run into trouble. Consumer tastes change. New competitors pop up. There might be regulatory changes or even scandals. That's why diversification is so important.
Right? The old don't put all your eggs in one basket advice. Spreading your investments across different companies, different industries, and different types of assets is key to managing your risk.
Exactly. Building a diversified portfolio is like building a strong foundation. It helps to minimize the impact if one particular company does poorly or if the entire market takes a dip.
So it's about being informed, understanding the risks, and making smart choices that match your goals and your risk tolerance. It's about taking that long-term perspective, not letting those short-term fluctuations freak you out, and staying focused on where you want to be in the future.
And maybe the most important thing of all is continuous learning. The financial world is always changing, so staying curious, asking questions, and always trying to learn new things are crucial. This book gives us a lot of great insights, but it's just the beginning. There's always more to learn, more to explore, and more to discover in the world of finance.
Well said. This deep dive has been a fascinating journey. We've covered so much, from IPOs to hedge funds, from corporate governance to stock picking, and hopefully everyone listening is feeling a little more informed and a lot more empowered to navigate this complex world.
It's been a pleasure joining you on this journey. Remember, knowledge is power, especially when it comes to your finances. So keep learning, stay curious, and make informed decisions that align with your goals and your vision for the future.
Thank you for joining us on the deep dive. Up till next time, happy learning.